but illustrated this point with an anecdote. A man says to a veterinarian, "Can you help me? Sometimes my horse walks just fine, and sometimes he limps." The vet replied, "Not a problem. When he's walking fine, sell him." The most important task in capital allocation is to take cash generated by a company and deploy it to the very best opportunity, and avoid what Buffett called the institutional imperative. Rationality frequently wilts when the institutional imperative comes into play. For example, 1. As if governed by Newton's first law of motion, an institution will resist any change in its current direction. 2. Just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. 3. Any business craving of the leader, however foolish, will be quickly supported by detailed rate of return and strategic studies prepared by his troops. And 4. The behavior of peer companies, whether they are expanding, acquiring, setting executive compensation, or whatever, will be mindlessly imitated. Warren Buffett, Berkshire Annual Meeting, 1989. The culture at Berkshire has been created by Buffett and Munger so as to reject the institutional imperative like a foreign body. Buffett has devoted considerable time to making sure this attribute is part of his legacy to Berkshire. He has written that at Berkshire, a managerial wish list will not be filled at shareholder expense, and continued his lecture. Many managerial princes remain serenely confident about the future potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads. Warren Buffett, 1981 Berkshire Shareholder Letter, 1982. The heads of many companies are not skilled in capital allocation. Their inadequacy is not surprising. Most bosses rise to the top because they have excelled in an area such as marketing, production, engineering, administration, or sometimes institutional politics. Once they become CEOs, they face new responsibilities. They now must make capital allocation decisions, a critical job that they may have never tackled and that is not easily mastered. CEOs who recognize their lack of capital allocation skills, which not all do, will often try to compensate by turning to their staffs, management consultants, or investment bankers. Charlie and I have frequently observed the consequences of such help. On balance, we feel it's more likely to accentuate the capital allocation problem than to solve it. In the end, plenty of unintelligent capital allocation takes place in corporate America. That's why you hear so much about restructuring. Warren Buffett, 1987, Berkshire Annual Letter, 1988. 2. Compensation systems that create alignment with shareholders. Munger believes that compensation systems are too important to delegate. It isn't enough to buy the right business. You also have to have a compensation system that's satisfactory to the people running them. At Berkshire Hathaway, we have no single system. We have different systems. They're very simple, and we don't tend to revisit them very often. It's amazing how well it's worked. We wrote a one-page deal with Chuck Huggins when we bought Seas, and it's never been touched. We have never hired a compensation consultant. Charlie Munger, Wesco Annual Meeting, 2005. A man does not deserve huge amounts of pay for creating tiny spreads on huge amounts of money. Any idiot can do it, and, as a matter of fact, many idiots do. Charlie Munger, Wesco Annual Meeting, 2009. I'd rather throw a viper down my shirt front than hire a compensation consultant. Charlie Munger, Berkshire Annual Meeting, 2004. This task is particularly hard in the case of Berkshire because the Berkshire managers, in most cases, are already rich and have little financial need to work. For this reason, Munger and Buffett select managers who love what they do enough that financial motivation is only part of the reason to work as CEOs. Someone who knows many of the Berkshire CEOs well once told me that they love working for Buffett and Munger, and that the level of personal loyalty to the two billionaires who run Berkshire is quite high. the best place to see the Berkshire compensation philosophy set out is in the Berkshire Owner's Manual, which can be found on the Berkshire website, www.berkshirehathaway.com/owners.htm. Micromanaging what the CEOs of their portfolio companies do is not part of the Berkshire playbook, says Munger. In any big business, you don't worry whether someone is doing something wrong. You worry about whether it's big and whether it's material. You can do a lot to mitigate bad behavior, but you simply can't prevent it altogether. Charlie Munger, Berkshire Annual Meeting 2012. Of course, fear of micromanagement is not a reason to abdicate all management responsibilities. A board of directors letting a parade of managers run down a business is not justified by a fear of micromanagement. Delegation to the extent practiced by Berkshire Hathaway only works if you follow this rule as described by Munger. Our success has come from the lack of oversight we've provided, and our success will continue to be from a lack of oversight. But if you're going to provide minimal oversight, you have to buy carefully. It's a different model from GE's. GE's works. It's just very different from ours. Charlie Munger, Notes from the Berkshire Hathaway Annual Meeting 2005. 3. Moat widening skills. Munger would rather have a great moat than great managers. Of course, he would rather have both, so he has a greater margin of safety. To make this point, Buffett commented that good jockeys will do well on good horses, but not on broken-down nags. For example, both the New England textile business and the department stores that Berkshire owned in its very early years had competent managers, but the underlying businesses the managers were employed to run were lodged in quicksand. No amount of managerial skill could have fixed the problems at these companies. As another example, Ron Johnson, who formerly was in charge of Apple's retail operations, may be a great manager of a retail business, but the fact that the next business he ran, J.C. Penney, was fundamentally a lousy business made the critical difference in terms of a financial result. Munger admits there are rare exceptions in which the quality of the business is less of a driving factor. So you do get an occasional opportunity to get into a wonderful business that's being run by a wonderful manager. And of course, that's hog heaven day. If you don't load up when you get those opportunities, it's a big mistake. Averaged out, betting on the quality of business is better than betting on the quality of management. In other words, if you have to choose one, bet on the business momentum, not the brilliance of the manager. But very rarely, you find a manager who's so good that you're wise to follow him into what looks like a mediocre business. Charlie Munger, USC Business School, 1994. The only duty of a corporate executive is to widen the moat. We must make it wider. Every day is to widen the moat. We gave you a competitive advantage, and you must leave us the moat. There are times when it's too tough, but duty should be to widen the moat. I can see instance after instance where that isn't what people do in business. One must keep their eye on the ball of widening the moat, to be a steward of the competitive advantage that came to you. A general in England said, "Get you the sons your fathers got, and God will save the Queen." At Hewlett-Packard, your responsibility is to train and deliver a subordinate who can succeed you. It's not all that complicated, all that mumbo-jumbo. We make bricks in Texas, which use the same process as in Mesopotamia. Charlie Munger, Wesco Annual Meeting, 2008. Munger wants managers of the business who have an ownership mentality toward the business, not just the attitude of manager. Carnegie was always proud that he took very little salary. Rockefeller and Vanderbilt were the same. It was a common culture in a different era. All of these people thought of themselves as the founder. I was delighted to get rid of the pressure of getting fees based on performance. If you're highly conscientious and you hate to disappoint, you will feel the pressure to live up to your incentive fee. There was an enormous advantage to switching away from taking a percentage of the profits to managing Berkshire. in which their interests as shareholders are exactly aligned with other shareholders. Charlie Munger, Berkshire Annual Meeting 2003. Munger and Buffett also want managers to have what Nassim Taleb calls skin in the game. They hate situations in which the result is heads managers win and tails managers do not lose. They want risk and benefits to be symmetrically allocated. For Munger, the presence of the right incentives for a manager is critical. Buffett added that he wants to see managers have a major portion of their net worth invested in the company. We eat our own cooking. Munger also fears bureaucracy, and Berkshire works hard to prevent it from lowering returns by creating what they call a seamless web of deserved trust. For example, if you worked for AT&T in my day, it was a great bureaucracy. Who in the hell was really thinking about the shareholder or anything else? And in a bureaucracy, you think the work is done when it goes out of your in-basket into somebody else's in-basket. But of course it isn't. It's not done until AT&T delivers what it's supposed to deliver. So you get big, fat, dumb, unmotivated bureaucracies. The constant curse of scale is that it leads to big, dumb bureaucracy, which, of course, reaches its highest and worst form in government, where the incentives are really awful. That doesn't mean we don't need governments, because we do. But it's a terrible problem to get big bureaucracies to behave. Charlie Munger, University of Southern California Business School, 1994. 4. Management already in place with integrity. Munger has made it clear that integrity as a business attribute is just as important as talent. Most important, Munger values integrity for itself. Working with people who have integrity is its own reward. As a bonus, being able to count on the integrity of a manager is efficient because it means that fewer resources are required to ensure honesty and compliance. We would vastly prefer a management in place with a lot of integrity and talent. Charlie Munger, BBC interview, 2009. For Munger, a zero-tolerance policy applies to anything related to a lack of integrity. In other words, a standard of mostly honest is not a goal for Munger when it comes to integrity. Buffett repeatedly had pointed out that a reputation gained over a lifetime can be lost in less than a second. Munger believes, remember that reputation and integrity are your most valuable assets and can be lost in a heartbeat. Charlie Munger, Poor Charlie's Almanac, 2005. Hoping that the negative impact of some dishonest people can be managed by mixing them in with honest people is a triumph of hope over experience in Munger's view. When you mix raisins with turds, they are still turds. Charlie Munger, Berkshire Annual Meeting 2000. It can be harder to spot a lack of integrity than many people imagine, and the consequences can be significant. Munger makes it clear that he has no desire to buy an otherwise good business with lousy management and then try to find someone to run it. We don't train executives, we find them. If a mountain stands up like Everest, you don't have to be a genius to figure out that it's a high mountain. Charlie Munger, Berkshire Annual Meeting, 2006. Munger and Buffett are not interested in investing in company turnarounds because they seldom actually do turn around. Munger wants the moat of the company he is investing in to be strong enough to survive bad management. As was discussed previously, he would prefer to have a moat that is so strong that it could survive if the company was run by an idiot. Neither Buffett nor Munger is going to buy a business and let some friend or relative run it. However, if they hypothetically did, they would hope that it would still perform adequately as a business with an idiot manager due to the moat. Network TV in its heyday, anyone could run and do well. If Tom Murphy is running it, you do very well. But even your idiot nephew could do well. Charlie Munger, Berkshire Hathaway Annual Meeting, 2006. Munger is not saying that management does not matter. Instead, he is saying that he would prefer to have a business that passes the idiot manager test, and for the business to have talented management. Owning a business that has lousy underlying economics and that is facing one hard problem after another may not have a good financial outcome even with a top-notch management team, according to Munger. In that sense, having a moat and talented management, such as the team that runs the Berkshire portfolio company ISCAR, gives Buffett and Munger an extra margin of safety when making an investment. 5. The rare exceptional manager. Occasionally, Munger and Buffett find a person who has such superior talent that they really do not need much of a moat. This situation is rare, but it does happen. Occasionally, you'll find a human being who's so talented that he can do things that ordinary skilled mortals can't. I would argue that Simon Marx, who was second generation in Marks and Spencer of England, was such a man. Patterson was such a man at National Cash Register, and Sam Walton was such a man. These people do come along, and in many cases, they're not all that hard to identify. If they've got a reasonable hand, with the fanaticism and intelligence and so on that these people generally bring to the party, then management can matter much. However, averaged out, betting on the quality of a business is better than betting on the quality of management. In other words, if you have to choose one, bet on the business momentum, not on the brilliance of the manager. But very rarely, you find a manager who's so good that you're wise to follow him into what looks like a mediocre business. Charlie Munger, USC Business School, 1994. Sometimes, as is the case with Berkshire itself, it is worthwhile to bet on a superior manager. Munger has said, "There are people, very few, worth paying up to get in with for a long-term advantage." Charlie Munger, Damn Right, 2000. Buffett has pointed out that the talents of Ajit Jain in the reinsurance business are just such a case. Buffett said at the most recent Berkshire meeting, Ajit Jain has created tens of billions of dollars in value for this company out of nothing but brain and hard work. That is high praise indeed, because there's no mention of any moat in that business by Munger and Buffett. Munger feels that the management of a company like Costco is a case in which management adds to the company moat. For example, he's a huge fan of Costco's James Sinegal, but he clearly feels that companies which have managers like Costco are not easy to find. I think it's dangerous to rely on special talents. It's better to own lots of monopolistic businesses with unregulated prices. But that's not the world today. We have made money exercising our talents and will continue to do so. I'm glad we have insurance, though it's not a no-brainer. I'm warning you, we have to be smart to make this work. Charlie Munger, Wesco Annual Meeting, 2002. Munger also believes that a skilled manager can sometimes find a relatively safe market niche. I find it quite useful to think of a free market economy, or partly free market economy, as sort of the equivalent of an ecosystem. Just as animals flourish in niches, people who specialize in some narrow niche can do very well. Charlie Munger, USC Business School, 1994. This strategy is similar to what Professor Michael Porter calls differentiation. This approach can be workable, but it is inherently riskier to try to find a haven from competition in a niche than to have a moat. Sometimes it is better to have both. An example of a niche market in which Munger and Buffett believe they found a gem of a management team is ISCAR. Judging the management at a company like ISCAR is easy. Those people are enormously talented and wonderful. But there aren't many managements like that, and few people with the incentive of such intensity. Charlie Munger, Wesco Annual Meeting, 2011. The reason I got so high on it so fast was that the people are so outstandingly talented. The idea of being in business with them just struck me worth straining for. We didn't know when we were young which things to stretch for, but by the time we reached ISCAR, which we never would have bought when we were young, we knew to stretch for the right people. It's a hell of a business. Everything is right there. Isn't it good that we keep learning? Better late than never. Charlie Munger, Wesco Annual Meeting, 2007. This description by Bill Gates of the Berkshire philosophy on the importance of management to a business is a very useful summary. Warren's penchant for long-term investments is reflected in another aphorism. You should invest in a business that even a fool can run, because someday a fool will. He doesn't believe in businesses that rely for their success on every employee being excellent. Nor does he believe that great people help all that much when the fundamentals of a business are bad. He says that when good management is brought into a fundamentally bad business, it's the reputation of the business that remains intact. Warren installs strong managers in the companies Berkshire owns, and tends to leave them pretty much alone. His basic proposition to managers is that to the degree that a company spins off cash, which good businesses do, the managers can trust Warren to invest it wisely. He doesn't encourage managers to diversify. Managers are expected to concentrate on the businesses they know well, so that Warren is free to concentrate on what he does well. Invest. Bill Gates, Fortune, 1996. With that last bit of wisdom, I send you off into the world, hoping that you too learn to concentrate and invest successfully. Whenever in doubt about making a decision related to investing or otherwise, ask yourself this: what would Charlie Munger do? Berkshire Math. In making an intrinsic value calculation, Berkshire uses the long-term 30-year U.S. Treasury rate as the discount rate. This is not a typical approach, and many people do not fully understand why Berkshire uses this rate. Buffett explained, "We use the risk-free rate merely to equate one item to another. In other words, we're looking for whatever is the most attractive. In order to estimate the present value of anything, we're going to use a number, and obviously, we can always buy government bonds. Therefore, that becomes the yardstick rate, to simply compare all kinds of investment opportunities across the spectrum." Warren Buffett, Berkshire Annual Meeting, 1997. What is happening in this process is an examination of opportunity cost. Intelligent people make decisions based on opportunity costs. In other words, it's your alternatives that matter. That's how we make all of our decisions. Charlie Munger, Berkshire Annual Meeting, 2003. Munger thinks about the opportunity cost of capital by considering what the alternatives are for that capital. Buffett has said, "Charlie and I don't know our cost of capital. We measure everything against our alternatives." Why would you buy an investment that is not in your top 2% of opportunities? As has been explained previously, this will lead to a concentrated portfolio that is perfectly acceptable to Munger, because he believes that risk comes from not knowing what you are doing. He has adopted a focused investing style, which will be explained below. How does Munger account for risk when he buys an asset? He will only invest if he strongly believes the current earnings are nearly certain to continue. While most other investors will adjust the discount rate for what they may believe to be greater risk, Berkshire wants essentially no risk as a starting point. In other words, rather than adjust the discount rate to account for risk, Munger and Buffett use a risk-free rate to compare alternative investments. They look for both conservatively determined fundamentals and a stable business history, which indicate to them that the current state of the business in question will continue. However, to provide a cushion against mistakes, they will not actually buy an asset without at least a 25% discount in intrinsic value. This discount is their margin of safety. The theory behind Munger's very different approach to dealing with risk is worth examining in detail. As a review, risk is the possibility of suffering a loss, not price volatility. The way Berkshire deals with risk is by buying what they feel is a conservatively valued asset with no risk at a discount price. Their focus is on having protection against mistakes that they may make during that process. What they do not do is increase the interest rate used in the computation to deal with risks inherent in the business. If there are significant risks inherent in the business itself, they put the decision in the too hard pile and move on to other potential opportunities. The mathematical process that Munger and Buffett use at Berkshire is simple. Please do not stop reading because I used the word mathematics. First, Berkshire calculates the past and current owner's earnings of the business. Then they insert into the formula a reasonable and conservative growth rate of the owner's earnings. They solve for the present value of the owner's earnings by discounting using the 30-year U.S. Treasury rate. The focus of the investing process at Berkshire is on return on equity, ROE, not earnings per share, EPS. As an aside, Munger believes that every manager of a business should be thinking about intrinsic value when making all capital allocation decisions. Note that Berkshire does not use price-to-earnings multiples in calculating value. Owner's earnings is a very specific type of earnings, and they stick to that set of figures. In determining intrinsic value, Munger doesn't swallow the stories of promoters who sing songs and tell tall tales about EBITDA, earnings before interest, taxes, depreciation, and amortization, EBITDA, and non-GAAP, generally accepted accounting principles, earnings. He likes genuine free cash flow. He considers drowning in cash to be a very good thing indeed. On the topic of non-GAAP earnings, Munger has said this: I don't even like to hear the word EBITDA. Charlie Munger, Q&A with 6 Business Schools, 2009. Moats. Munger has not explained his theories on what creates and sustains a moat as comprehensively as Buffett, but he has made some comments that point people in the right direction. The 5 primary elements that can help create a moat are as follows. 1. Supply-side economies of scale and scope. If a company's average costs fall when more of a product or service is produced, there are supply-side economies of scale. Intel is a classic example of a business that benefits from economies of scale. In Munger's view, Walmart has substantial supply-side economies of scale through its investments in distribution and other systems. Companies that operate huge steel plants and shipyards can also have supply-side economies of scale. Munger described 2 different supply-side economies of scale. On the subject of economies of scale, I find chain stores quite interesting. Just think about it. The concept of a chain store was a fascinating invention. You get this huge purchasing power, which means that you have lower merchandise costs. You get a whole bunch of little laboratories out there in which you can conduct experiments. And you get specialization. If one little guy is trying to buy across 27 different merchandise categories influenced by traveling salesmen, he's going to make a lot of dumb decisions. But if your buying is done in headquarters for a huge bunch of stores, you can get very bright people who know a lot about refrigerators and so forth to do the buying. The reverse is demonstrated by the little store where one guy is doing all the buying. So there are huge purchasing advantages. Some supply-side advantages come from simple geometry. If you're building a great circular tank, obviously, as you build it bigger, the amount of steel you use in the surface goes up with the square and the cubic volume goes up with the cube. So as you increase the dimensions, you can hold a lot more volume per unit area of steel. There are all kinds of things like that where the simple geometry, the simple reality, gives you an advantage of scale. Charlie Munger, University of Southern California Business School, 1994. You can get advantages of scale from TV advertising. When TV advertising first arrived, when talking color pictures first came into our living rooms, it was an unbelievably powerful thing. And in the early days, we had 3 networks that had whatever it was, say 90% of the audience. Well, if you were Procter & Gamble, You could afford to use this new method of advertising. You could afford the very expensive cost of network television because you were selling so damn many cans and bottles. Some little guy couldn't. And there was no way of buying it in part. Therefore, he couldn't use it. In effect, if you didn't have big volume, you couldn't use network TV advertising, which was the most effective technique. So when TV came in, the branded companies that were already big got a huge tailwind. Charlie Munger, USC Business School, 1994. Although Berkshire was a bit late to appreciate the financial attractiveness of the railroad business, Munger and Buffett clearly value the moat that supply-side economies of scale create in that business. A new competitor in the railroad business is highly unlikely. If the public roads deteriorate because the United States underinvests in infrastructure, Buffett and Munger believe railroads will become even more valuable. Munger is very positive on the future of the railroad business. Do you know what it would cost to replace Burlington Northern today? We are not going to build another transcontinental. And those assets are valuable, have utility. Now they want to raise diesel prices on trucks. We finally realized that railroads now have a huge competitive advantage with double-stacked rail cars, guided by computers, moving more and more production from China, etc. They have a big advantage over truckers in huge classes of business. Charlie Munger, Wesco Annual Meeting, 2008. We don't know how to buy stocks by metrics. We know that Burlington Northern will have a competitive advantage in years. We don't know what the heck Apple will have. You really have to understand the company and its competitive positions. That's not disclosed by the math. Charlie Munger, Berkshire Annual Meeting 2013. The railroad industry is interesting in that long ago they were a growth industry that created both great fortunes and great busts in the aftermath of that success. There were many times in history when railroads were very lousy investments. Regarding the impact of supply-side economies of scale, Munger has pointed out, in some businesses, the very nature of things cascades toward the overwhelming dominance of one firm. It tends to cascade to a winner-take-all result. And these advantages of scale are so great, for example, that when Jack Welch came into General Electric, he just said, to hell with it. We're either going to be number 1 or 2 in every field we're in, or we're going to be out. That was a very tough-minded thing to do, but I think it was a correct decision if you're thinking about maximizing shareholder wealth. Charlie Munger, USC Business School, 1994. If it is cost-efficient for a company to produce several different products or services, a company can also benefit from supply-side economies of scope. To benefit from economies of scope, a business must share resources across markets, while keeping the amount of those resources largely fixed. Businesses that desire to benefit from economies of scope must avoid running as isolated units. 2. Demand-side economies of scale. Network effects. Demand-side economies of scale, also known as network effects, result when a product or service becomes more valuable as more people use it. Craigslist, eBay, Twitter, Facebook, and other so-called multi-sided markets have demand-side economies of scale that operate on their behalf. American Express is an example of a company in the Berkshire portfolio with network effect benefits. The more merchants that accept their card, the more valuable the service gets. And the more people who use the card, the more valuable the services are for merchants. Munger has said, it would be easier to screw up American Express than Coke or Gillette, but it's an immensely strong business. Charlie Munger, Berkshire Annual Meeting, 2000. A company having beneficial network effects is only one dimension that impacts profit. Sometimes network effects exist, but the market is small because it is a niche. Amazon's market is massive, and that matters greatly in terms of the market capitalization it can generate. Some network effects are very strong and some are weak. Some companies have both demand-side and supply-side economies of scale. Amazon has both supply-side and demand-side economies of scale, and they reinforce each other. The more people who provide comments on Amazon, the more valuable it becomes to other users due to demand-side economies. Amazon also has huge advantages with their warehouses and the supply chain on the supply side. 3. Brand. Understanding how Munger thinks about brand is best illustrated by an example. For many years, Munger was the chairman of a company called Wesco Financial. At the 2011 meeting of Wesco, which was held just before it was merged into Berkshire Hathaway, Munger admitted that he and Buffett really did not understand the value of a brand until they bought See's Candies. See's Candies is also a great side-by-side test of brand power. To illustrate, if you grew up in a home that bought See's Candies, mostly on the West Coast, especially in California, and your experiences around that candy have very favorable associations, you will pay more for a box bearing the See's Candies brand. By contrast, someone who grew up on the East Coast of the United States will not attribute much value to that brand because they do not have those same experiences. For this reason, See's Candies has found it hard to expand regionally and has done so very slowly. What See's Candies sells is not just food, but rather an experience. Because box candy sales are highest during holiday seasons, the financial results of the company are also very lumpy. See's Candies generates losses 2 quarters a year and makes all its profits in the other 2 quarters around 3 holidays. Buffett talks about the fact that building some brands took many decades. When you were a 16-year-old, you took a box of candy on your first date with a girl and gave it either to her parents or to her. In California, the girls slap you when you bring Russell Stover and kiss you when you bring See's. I don't think See's means anything to people on the East Coast, where people are also exposed to higher-end chocolate products. Warren Buffett. The Secrets of See's Candies, Fortune Magazine, 2012. While some of the power of a brand can come from taste, modern flavor firms can replicate almost any taste. Trade dress and presentation of a good or service matters more than ever. A lot of Tiffany's brand power lies in the blue box the jewelry comes in. Coke made a massive mistake thinking it was flavor that mattered most in a blind taste test when it introduced New Coke. When the taste test was not blind, Coke won. When it was blind, Coke did not win. Munger said once about the New Coke episode, Coke spent 100 years getting people to believe that trademark had all these intangible values too, and people associate it with a flavor. Pepsi was within weeks of coming out with Old Coke in a Pepsi bottle, which would have been the biggest fiasco in modern times. Perfect insanity. Charlie Munger, Harvard University, 1995. A moat powered by a brand is something very different from one created via supply-side or demand-side economies of scale. For example, Buffett believes that for a company like Disney, when the brand is mentioned in conversation, you have something in your mind. He added, how would you try to create a brand that competes with Disney? Coke is a brand associated with people being happy around the world. That is what you want to have in a business. That is the moat. You want that moat to widen. Warren Buffett, Vanderbilt Visit Notes, 2005. Brands, of course, can fail over time. Put a luxury brand on a shelf at Costco, as some have done, and that luxury brand can be damaged for certain customers. License it too broadly, and the brand can also be damaged. Buffett and Munger are attracted to brands that they use in their own lives. See's Candies and Dairy Queen are just 2 examples. Some brands incur problems with their brand that are completely self-inflicted. Buffett went on to say about one of his most favorite brands, take See's Candies. You cannot destroy the brand of See's Candies. Only See's can do that. You have to look at the brand as a promise to the customer that we are going to offer the quality and service that is expected. We link the product with happiness. You don't see See's Candies sponsoring the local funeral home. We are at the Thanksgiving Day parades, though. Warren Buffett. Notes from University of Georgia visit, 2007. Regarding brand power, the two Berkshire leaders have often cited Wrigley's as a brand that creates a strong moat. Munger has pointed out, the informational advantage of brands is hard to beat, and your advantage of scale can be an informational advantage. If I go to some remote place, I may see Wrigley chewing gum alongside Glotz's chewing gum. Well, I know that Wrigley is a satisfactory product, whereas I don't know anything about Glotz's. So if one is 40 cents and the other is 30 cents, am I going to take something I don't know and put it in my mouth? Which is a pretty personal place, after all, for a lousy dime? So in effect, Wrigley, simply by being so well known, has advantages of scale, what you might call an informational advantage. Everyone is influenced by what others do and approve. Another advantage of scale comes from psychology. The psychologists use the term social proof. We are all influenced, subconsciously and to some extent consciously, by what we see others do and approve. Therefore, if everybody's buying something, we think it's better. We don't like to be the one guy who's out of step. Again, some of this is at a subconscious level and some of it isn't. Sometimes we consciously and rationally think, gee, I don't know much about this. They know more than I do. Therefore, why shouldn't I follow them? All told, your advantages can add up to one tough moat. Charlie Munger, USC Business School, 1994. A very important test for Buffett and Munger in determining the strength of a brand-based moat is whether a competitor can replicate or weaken the moat with a massive checkbook. As just one example, here is what Buffett said about Coke at the 2012 Berkshire meeting. If you gave me $10, $20, $30 billion to knock off Coca-Cola, I couldn't do it. That is, in his view, what defines a strong moat. Firms like Nike and BMW each have brands that help maintain their moat, which were hard to get and are super valuable to have. Michael Mauboussin wrote, brands do not confer advantages in and of themselves. Brands only increase value if they increase customer willingness to pay or reduce the cost to provide the good or service. The creation of a great brand is a rare thing that requires considerable skill, and arguably a big dose of luck as well. 4. Regulation. Certain businesses have created a competence with regard to regulation that is so strong that the regulation itself actually serves as a moat. Regulations can often end up protecting existing entrenched producers rather than helping consumers. For example, some people believe banks have created such a powerful layer of regulatory expertise that the regulators have become captured by the industry they regulate. Similarly, there are a number of professional guilds, like lawyers, that have been able to use regulation to limit supply. For Berkshire, the regulation-driven moat that Moody's possessed in the bond rating business was a big attraction. To issue bonds, regulators actually required that the issuer get an opinion from a very small number of bond rating firms, which means that rating firms like Moody's, S&P, and Fitch have a moat. When regulation disappears, it often becomes quickly evident that it was a major factor in industry profitability. In other words, you find out who is swimming naked when the regulatory-driven moat disappears. 5. Patents and intellectual property. Companies that have been granted a patent, trademark, or other type of intellectual property by the government have in effect been given a legal monopoly. This barrier to entry can create a substantial moat for the owner of the intellectual property. You may or may not think too many patents have been granted, or have been granted in inappropriate ways. But the value of a patent, once granted, is a different point. Regarding the value of intellectual property, Munger has said this. In microeconomics, of course, you've got the concept of patents, trademarks, exclusive franchises, and so forth. Patents are quite interesting. When I was young, I think more money went into patents than came out. Judges tended to throw them out based on arguments about what was really invented and what relied on prior art. That isn't altogether clear, but they changed that. They didn't change the laws, they just changed the administration so that it all goes to one patent court, and that court is now very much more pro-patent. So I think people are now starting to make a lot of money out of owning patents, but trademarks and franchises have always been great. Trademarks, of course, have always made people a lot of money. A trademark system is a wonderful thing for a big operation if it's well known. Charlie Munger, USC Business School, 1994. One example of a company that Berkshire values higher due to intellectual property patents is Lubrizol. Buffett said once, "It struck me as a business I didn't know anything about initially. You're talking about petroleum additives. Are there competitive moats? Is there ease of entry? All that sort of thing? I did not have any understanding of that at all initially. And I talked to Charlie a few days later, and Charlie says, I don't understand it either." Warren Buffett, Berkshire Annual Meeting, 2008. Eventually, Buffett was won over and made the Lubrizol purchase. Buffett said once, "I decided there's probably a good-sized moat on this. They've got lots and lots of patents. But more than that, they have a connection with customers." Warren Buffett, Berkshire Annual Meeting, 2008. At the 2011 Berkshire meeting, Buffett reiterated that he decided to go ahead because he thought that the more than 1,600 patents held by Lubrizol would give the company a durable competitive advantage. Another example of intellectual property proving its value for Munger occurred in the 1970s when Russell Stover Candies started to open stores in markets served by See's Candies. The Russell Stover stores were designed to be very similar in appearance to See's Candies stores. By asserting intellectual property rights, Munger was able to get an agreement from Russell Stover to stop opening similar stores through the threat of litigation. Cumulative impact of many factors. Some businesses, like Berkshire, have been able to create a moat as a result of a combination of better systems and culture than their competitors. One way to understand this point is to look at Berkshire and ask whether it has a moat. In other words, while Berkshire has Buffett and Munger, what else does the company have that acts as a barrier to entry, creating sustainable competitive advantage? Berkshire has many elements that make up the whole of its moat, and they are further amplified by the way the elements fit together. In short, the aggregate value that these elements create is greater than the sum of the parts. This section presents a few of the elements that collectively create Berkshire's moat. 1. Berkshire is tax efficient. When a given Berkshire portfolio company, e.g. See's Candies, generates cash, that cash is rarely invested in more See's Candies stores, manufacturing plants, or acquisitions because the return on capital would be lower than other alternatives within Berkshire. Because of Berkshire's structure, Buffett is able to move that cash from See's Candies to the greatest opportunity on a tax-efficient basis, without paying the tax that would be imposed if See's Candies paid a dividend, or See's shares were sold and the money reinvested. Buffett elaborated, "Because we still have this ability to redistribute money in a tax-efficient way within the company, we can reallocate it to where it will earn a higher return than shareholders may on their own." Warren Buffett, Berkshire Annual Meeting, 2008. Munger added this, "Another very simple effect I seldom see discussed by either investment managers or anybody else is the effect of taxes. If you're going to buy something which compounds for 30 years at 15% per annum, and you pay 135% tax at the very end, the way that works out is that after taxes, you keep 13.3% per annum. In contrast, if you bought the same investment but had to pay taxes every year of 35% out of the 15% that you earned, then your return would be 15% minus 35% of 15%, or only 9.75% per year compounded. so the difference there is over 3.5%. And what 3.5% does to the numbers over long holding periods, like 30 years, is truly eye-opening. If you sit back for long stretches in great companies, you can get a huge edge from nothing but the way that income taxes work. Charlie Munger, USC Business School, 1994. WB talks about increasing book value after paying full corporate taxes of 35%. Indices don't have to pay taxes. Charlie Munger, Berkshire Annual Meeting, 2014. 2. Berkshire has low overhead. At a Wesco meeting, Munger said, "A lot of people think if you just had more process and more compliance, checks and double checks and so forth, you could create a better result in the world. Well, Berkshire has had practically no process. We had hardly any internal auditing until they forced it on us. We just try to operate in a seamless web of deserved trust and be careful whom we trust." Charlie Munger, Wesco Annual Meeting, 2007. Trust-based systems in which managers must eat their own cooking are core to Berkshire's culture, which translates to lower overhead. The New York Times put it this way: Berkshire has a corporate headquarters with a mere 25 people on a single floor of an office building. From there, Mr. Buffett and his staff allocate capital and contemplate acquisitions or sales, hire or fire people to run those portfolio companies, and otherwise stay out of the way. New York Times, 2014. Morningstar added, "All of the firm's operating companies are managed on a decentralized basis, eliminating the need for layers of management control and pushing responsibility down to the subsidiary level, where managers are empowered to make their own decisions." In order for this seamless web of deserved trust system to work, you must have great managers and have the right incentives in place. Berkshire's culture is designed to ensure that anyone who succeeds Buffett will know how to do this. Buffett said at the 2014 Berkshire shareholders meeting that if Berkshire has a weakness, it is that they tend to overtrust. But with that comes low overhead. The seamless web of trust system is itself part of the Berkshire moat. 3. Berkshire is the private buyer of first resort. If you have spent your life building a business and decide to sell the company, Buffett and Munger offer you a unique opportunity. They will let you, and in fact want you, to continue running the business. Your other option is selling the business to a private equity firm that does not give a damn about your business and will probably load it up with debt, creating a serious risk that the company will fail. Buffett has a track record of keeping the business instead of playing what Munger calls a game of gin rummy with it and other holdings, which makes Berkshire attractive to many sellers of a business. People who sell businesses to Berkshire are rich enough that they have more money than they will ever need. Berkshire gives the selling owner the chance to make sure that the business they care about and the people that work there continue to thrive. For this reason, Berkshire gets offered the opportunity to buy businesses at very attractive prices. Buffett said in the most recent shareholders meeting, private equity firms buy businesses, but they're looking to sell those holdings down the road. To reassure selling owners, Buffett holds on to businesses even if returns are less than stellar. Here's Buffett on this point. "You would not get a passing grade in business school if you put down our principles for why we keep some businesses. But we made promises. If we don't keep our promise, word would get around. We list the economic principles so managers who sell to us know they can count on it. We can't make some promises, and we don't promise never to sell. But we've only had to get rid of a few businesses, including the original textile business. We also let managers continue to run their business. We are now in a class that is hard to compete with. A private equity firm won't be impressed by what we put in the back of our annual report. People who are rich and run a company their grandfather started, they don't want to hand it over to a couple of MBAs who want to show their stuff. As long as we behave properly, we will maintain that asset. and many will have trouble competing with it. Warren Buffett, Berkshire Annual Meeting, 2014. This phenomenon creates a positive reputation for Berkshire and contributes to the moat. 4. Berkshire has permanent capital. Berkshire has permanent capital, which greatly enables the company to outperform other investors. Noted Graham value investor Bruce Berkowitz explained. That is the secret sauce. Permanent capital. That is essential. I think that's the reason Buffett gave up his partnership. You need it because when push comes to shove, people run. That's why we keep a lot of cash around. Cash is the equivalent of financial Valium. It keeps you cool, calm, and collected. Bruce Berkowitz, University of Miami interview, 2012. 5. Berkshire outperforms in down markets. Because Buffett and Munger are Graham value investors, Berkshire uses an investing approach designed to outperform in up markets and overperform in down markets. The goal of a value investor is superior absolute performance, not relative performance. Buffett put it simply, we will underperform in strong years, we will match in medium years, and we will do better in down years. We will outperform over a cycle, but there's no guarantee on that. Other investors, like Seth Klarman, use the same approach. The facts support this conclusion. Ben Carlson pointed out, it's the down years where Buffett has really extended his lead, outperforming the market by almost 25% per year when stocks fall. This is his secret sauce. Howard Marks pointed out the following rules for a value investor. Rule number 1. Most things will prove to be cyclical. Rule number 2. Some of the greatest opportunities for gain and loss come when other people forget rule number 1. Buffett has his own version of this, which states, rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Berkshire's results must be compared with alternatives on a risk-adjusted basis. 6. Berkshire benefits from float. Berkshire's insurance operations generate low-cost float, cash that comes in from insurance premiums collected well in advance of future insurance claims. This float is a major source of funding for investments. At Berkshire, float has grown from $39 million in 1970 to just over $77 billion in 2014, and significant amounts of that cash can be put to work within Berkshire. Because Berkshire has access to float, its financial returns will not be your financial returns unless you also own an insurance company. You will never be as rich as Buffett without access to float. However, that does not mean that you should not be a Graham value investor anyway. 7. High-quality shareholders, including Buffett and Munger. High-quality shareholders don't panic and think long-term about investing results. That a company may have a moat at a given time is insufficient. In Munger's view, even if you currently have a very profitable business, that does not mean that profitability will persist for very long. The process of what Joseph Schumpeter called creative destruction is as powerful as anything in business. Having a moat is the only way to fight against the tide of competitive destruction. Michael Mauboussin, in what is arguably the best essay ever on moats, wrote, companies generating high economic returns will attract competitors willing to take a lesser, albeit still attractive, return, which will drive down aggregate industry returns to the opportunity cost of capital. Michael Mauboussin, Measuring the Moat, 2002. For example, if you open a very successful clothing store with certain innovative attributes, that success will attract imitators and competitors. Through a process of creative destruction, some clothing stores will adapt and survive and thrive, and others will fail. The consumer wins because the products and services offered to them get better and better. However, this is a painful process for an investor, since the outcome can be highly uncertain. It is also the hardest part for a business person because failure is an essential part of capitalism. Given the inevitability of relentless competition, The question to ask, according to Munger, is as follows. How do you compete against a true fanatic? You can only try to build the best possible moat and continuously attempt to widen it. Charlie